The fast food industry has been facing a tough road since the pandemic, with many chains struggling to regain their footing. Rising costs, shifting consumer preferences, and increased competition have forced companies to rethink their strategies. Some brands are closing stores, while others are focusing on value menus or digital engagement to attract customers. The landscape is changing rapidly, and what worked before may no longer guarantee success. As a result, fast food giants are making bold moves to stay relevant in an increasingly challenging market. The fast food industry is facing a tough period, with several big names struggling to adapt to changing market conditions. Recently, Wendy's announced plans to close hundreds of U.S. restaurants after experiencing a sharp drop in sales, while Pizza Hut is also shutting down a significant number of locations due to declining market share and customer dissatisfaction. Even McDonald's, despite posting strong earnings, saw its CEO sell a large portion of his shares, raising questions among investors. Meanwhile, Taco Bell stands out as one of the few chains bucking the trend, thanks to its focus on value and digital engagement. Overall, these developments underscore the mounting challenges and uncertainty facing fast food giants today. Wendy's recently announced plans to close between 300 and 360 restaurants across the United States in 2026, which amounts to roughly 6% of its domestic locations. This move comes after a particularly tough year for the company, marked by a significant drop in same-store sales and overall profitability. The closures are part of a broader strategy to address underperforming sites and help franchisees focus on more successful locations. Wendy's leadership has emphasized that these changes are aimed at optimizing their system and responding to shifting consumer preferences. By concentrating on everyday value and launching a new tiered value menu, Wendy's hopes to regain momentum in a highly competitive fast food landscape. Wendy's has faced a tough year, marked by a steep financial downturn. The company's stock price has dropped by about 50%, reflecting investor concerns and broader challenges in the fast food sector. Net income also plunged by 44%, falling from $47.5 million in 2024 to just $26.1 million in 2025. These figures highlight a period of significant struggle for Wendy's, as declining sales and shifting consumer preferences have put pressure on its performance. The financial decline underscores the urgent need for strategic changes within the company. Wendy's has faced a sharp downturn in its same-store sales, with a 10.1% overall decline and an even steeper 11.3% drop in the United States. These figures highlight a challenging period for the company, as same-store sales are a key indicator of a brand's health and customer loyalty. The decline suggests that fewer customers are visiting Wendy's locations, and those who do are spending less. This trend has prompted the company to reassess its strategies, focusing on closing underperforming stores and introducing new value menus to regain customer interest. The sales collapse underscores the broader difficulties facing the fast food industry, where shifting consumer preferences and increased competition are forcing brands to adapt quickly. Customer reactions to Wendy's recent closures have been vocal and varied, with many expressing disappointment over declining service and management issues. Online comments frequently mention messy locations and poor employee development, suggesting that operational challenges have contributed to the brand's struggles. Nostalgia also plays a significant role, as some customers recall the days when Wendy's, under founder Dave Thomas, felt more authentic and inviting. Others criticize the shift toward smaller portions and higher prices, feeling that the brand has lost touch with its original values. These sentiments highlight how both practical concerns and emotional connections influence public perception during difficult times for the company. Dave Thomas, the founder of Wendy's, left a lasting mark on the brand with his approachable style and commitment to quality. Many longtime customers fondly remember his presence in iconic commercials and associate Wendy's best years with his leadership. Since his passing in 2002, some loyal patrons feel the chain has lost a bit of its original charm and direction. Comments from customers often mention a decline in service and food quality, suggesting that the brand hasn't quite been the same without Dave at the helm. His legacy continues to influence how people view Wendy's, especially during challenging times for the company. Many customers are increasingly dissatisfied with fast food chains, voicing concerns about declining food quality, shrinking portion sizes, and rising prices. Online comments often reflect frustration, with some people feeling that they're paying more for less and questioning whether these changes are driven by corporate priorities rather than customer satisfaction. The sentiment that fast food has lost its appeal is becoming more widespread, especially as consumers notice that their favorite menu items no longer offer the same value. This growing discontent highlights a shift in how the public perceives the industry, with many longing for the days when fast food was both affordable and enjoyable. The term in-shitification has gained traction as a way to describe the perceived decline in quality, value, and customer experience across many industries, including fast food. People often use it to express frustration with smaller portions, higher prices, and what they see as a prioritization of shareholder interests over consumer satisfaction. This sentiment is increasingly shaping public opinion, with many feeling that beloved brands have lost their way and are no longer delivering the value they once did. As these concerns grow, they reflect broader anxieties about the direction of the economy and the impact of corporate strategies on everyday life. The conversation around in-shitification highlights how consumer trust and loyalty can erode when companies fail to meet evolving expectations. Wendy's is taking decisive action to address its recent sales decline by launching a system optimization plan. This strategy centers on closing between 5% and 6% of its U.S. restaurants, specifically targeting locations that consistently underperform. By reducing the number of struggling outlets, Wendy's aims to help franchisees concentrate resources on more profitable sites, ultimately strengthening the brand's overall business. The company believes that this focused approach will lead to improved performance and better customer experiences across its remaining restaurants. This move reflects Wendy's commitment to adapting in a challenging market and prioritizing long-term stability. Wendy's is making a notable move to address its recent sales decline by shifting its focus toward everyday value. The company has introduced a permanent Biggie Deals value menu, offering price tiers at $4, $6, and $8. This change comes after realizing that limited-time promotions weren't enough to attract and retain customers. By making value offerings a staple rather than a temporary feature, Wendy's aims to draw in more guests and improve performance at its remaining locations. The strategy reflects a broader trend in the fast food industry, where affordability and consistent deals are becoming key to staying competitive. Wendy's recent shift toward a permanent value menu mirrors a strategy already employed by McDonald's, reflecting broader industry trends focused on affordability and everyday deals. Both chains have recognized that limited-time promotions aren't enough to sustain customer interest, so they're now emphasizing consistent tiered pricing to attract budget-conscious diners. McDonald's has seen positive results, with increased revenue and improved customer traffic, suggesting this approach resonates with consumers. Meanwhile, Wendy's hopes its Biggie Deals menu will help reverse declining sales and strengthen its competitive position. This move highlights how fast food giants are adapting to changing consumer expectations, prioritizing value and accessibility in a challenging economic climate. McDonald's has recently reported impressive financial results, with strong quarterly earnings that surpassed analyst expectations. The company saw its net revenue increase by 10% year-over-year, reaching $7 billion in the fourth quarter. Same-store sales also grew by 5.7%, indicating improved customer traffic and effective value strategies. Leadership credits these gains to listening to customer feedback and enhancing affordability across the menu. Despite the positive numbers, some industry observers are watching closely for signs of whether this momentum will continue. McDonald's CEO has emphasized the critical role of listening to customers in shaping the company's strategy. By actively responding to feedback, McDonald's has been able to improve traffic and strengthen its reputation for value and affordability. This approach has contributed to recent growth in same-store sales and overall revenue, suggesting that customer-centric initiatives are resonating with diners. The focus on everyday value, including menu adjustments and digital deals, reflects a broader industry trend toward meeting evolving consumer expectations. Ultimately, McDonald's commitment to understanding and adapting to customer needs appears to be a driving force behind its current success. Recently, McDonald's CEO Christopher Kempczinski sold over 26,000 shares of company stock, just one day after the release of strong quarterly earnings. This transaction, totaling around $8.7 million, reduced his ownership by more than half. While insider stock sales are not uncommon, the timing and scale of this sale have sparked speculation among investors about the company's future prospects. Some view it as a routine financial move, while others wonder if it signals concerns about sustaining recent performance. Ultimately, such actions can influence investor confidence and add an extra layer of scrutiny to the company's outlook. McDonald's has recently reported strong financial results, with notable growth in revenue and same-store sales. However, questions about the sustainability of this success have emerged, especially after CEO Christopher Kempczynski sold over half of his shares shortly after the earnings announcement. While insider stock sales are not uncommon, such significant transactions can spark speculation among investors about the company's future prospects. With the fast food industry facing ongoing challenges and shifting consumer preferences, it remains to be seen whether McDonald's can maintain its momentum or if these signs point to potential turbulence ahead. Wendy's is facing tough times, with plans to close up to 6% of its U.S. restaurants after a steep drop in sales and profits. Meanwhile, McDonald's seems to be weathering the storm, reporting strong earnings and growth in same-store sales. This contrast highlights a widening gap in the fast food industry, where some chains are struggling to adapt while others find ways to thrive. McDonald's focus on everyday value and digital engagement appears to be resonating with customers, whereas Wendy's is still searching for the right formula to regain its footing. The divide underscores how rapidly changing consumer preferences are reshaping the landscape for fast food giants. Pizza Hut is facing some tough times, with the company announcing plans to close 250 U.S. locations, about 4% of its total stores. This move comes as Pizza Hut's market share has steadily declined over the past few years, reflecting broader struggles in the fast food industry. Many customers have expressed dissatisfaction with both food quality and pricing, which has contributed to the brand's challenges. Despite exploring strategic options, including a possible sale, Pizza Hut has yet to announce any major changes beyond these closures. The situation highlights how even established names are feeling the pressure to adapt in today's competitive market. Pizza Hut has been facing a steady decline in the U.S. market over the past several years, with its market share dropping from 22.6% in 2019 to just 18.7% in 2024. This downward trend has led to the closure of 250 U.S. locations, representing about 4% of its stores. Many customers have voiced dissatisfaction with food quality and pricing, which has contributed to the brand's struggles. As a result, parent company Yum! Brands is exploring strategic options for Pizza Hut, including a potential sale, though no concrete developments have been announced. The ongoing challenges at Pizza Hut have impacted Yum! Brands' overall performance, especially as other portfolio brands like Taco Bell continue to outperform in the fast food sector. Pizza Hut has seen a notable decline in its market share over recent years, dropping from 22.6% in 2019 to just 18.7% in 2024. This downward trend reflects ongoing challenges for the brand, including increased competition and shifting consumer preferences. With the company closing hundreds of U.S. locations and facing criticism over food quality and pricing, it's likely that Pizza Hut's market share will continue to shrink. Many customers now perceive better value elsewhere, and the brand has struggled to regain its former popularity. As the fast food landscape evolves, Pizza Hut faces an uphill battle to reverse these losses. While Pizza Hut has faced a steady decline in market share and store closures, Domino's has managed to achieve modest growth during the same period. In the United States, Pizza Hut's same-store sales fell by 5% last year, whereas Domino's saw an increase of 2.7% in the first 9 months of 2025. Customer feedback suggests that Pizza Hut's challenges stem from dissatisfaction with food quality and pricing, making it harder for the brand to compete. Domino's, on the other hand, has benefited from a reputation for reliable service and value, helping it maintain a stronger position in the fast food pizza market. This contrast highlights how adapting to consumer preferences can make a significant difference in performance within the industry. Many customers have voiced their dissatisfaction with Pizza Hut, particularly regarding the decline in food quality and the feeling that prices no longer match what's offered. Online comments frequently mention that the pizzas are less flavorful and that portion sizes have shrunk over time. Some even compare the current offerings unfavorably to inexpensive frozen pizzas, saying they get better value elsewhere. The frustration is compounded by rising prices, with people expressing disappointment about paying premium rates for what they see as subpar meals. These sentiments reflect a broader perception that Pizza Hut's best days are behind it, and that the brand is struggling to deliver the value customers expect. Many people look back fondly on Pizza Hut's heyday, recalling the brand's affordable prices and memorable dining experiences in the 1990s and early 2000s. Today, however, there's a widespread feeling that Pizza Hut's best days are behind it. Customers often express disappointment with the current quality of food and rising prices, comparing them unfavorably to the past. This nostalgia is echoed in online comments, where former fans lament the decline and say they no longer visit Pizza Hut. The brand's struggles seem to reflect a broader shift in consumer expectations and the fast food landscape. Pizza Hut's recent decline is a clear reflection of broader challenges facing the fast food industry. Many customers have voiced frustration over rising prices and diminishing food quality, issues that aren't unique to Pizza Hut but are increasingly common across major chains. Once known for affordable and tasty offerings, Pizza Hut now struggles with perceptions that its products are overpriced and less appealing. This shift in customer sentiment has contributed to falling market share and store closures. The situation underscores how changing consumer expectations and economic pressures are reshaping the landscape for fast food brands everywhere. Yum Brands oversees several major fast food chains, including Pizza Hut, KFC, and Taco Bell. In recent years, both Pizza Hut and KFC have faced challenges, with declining sales and store closures reflecting their struggles to keep up with changing consumer preferences. However, Taco Bell has emerged as a bright spot in the portfolio, consistently outperforming its counterparts. Thanks to its focus on value, cultural relevance, and strong engagement with younger customers, Taco Bell has reported impressive growth, particularly in same-store sales and digital channels. This contrast highlights how different strategies and brand positioning can lead to varying outcomes within the same corporate family. Taco Bell has managed to stand out in a challenging fast food landscape, reporting an impressive 7% growth in same-store sales during the last quarter. This performance is especially notable given the broader industry slowdown affecting many competitors. The brand's focus on consistent value and its appeal to younger customers, particularly Gen Z, have played a key role in its success. Taco Bell's digital engagement strategies, including a growing loyalty program and app-exclusive offers, have also contributed to increased customer visits. While other chains struggle, Taco Bell's ability to stay culturally relevant and adapt to changing consumer preferences has helped it thrive. Taco Bell has managed to stand out in the fast food landscape by prioritizing value and staying culturally relevant. The brand consistently offers menu items at accessible price points, which resonates with younger customers looking for affordability. Taco Bell's leadership emphasizes understanding and adapting to shifting cultural trends, ensuring their offerings remain attractive to Gen Z. This approach is supported by a robust digital strategy, including a growing loyalty program and app-exclusive deals, which have led to a notable increase in active loyalty members and digital engagement. By blending value with cultural connection, Taco Bell continues to outperform competitors and maintain its appeal among younger diners. Taco Bell has managed to stand out in a challenging fast food landscape, thanks in large part to its focus on digital engagement. The company has seen a remarkable 31% increase in active loyalty members, which reflects how well its rewards program is resonating with customers. App-exclusive offers and digital channels have played a crucial role, encouraging frequent visits and boosting sales. By tailoring deals and rewards through their app, Taco Bell keeps younger consumers engaged and coming back for more. This strategy not only strengthens customer loyalty, but also positions the brand as culturally relevant and adaptable to changing consumer habits. Taco Bell stands out in the fast food landscape, managing to thrive even as competitors face declining sales and store closures. A key factor in their success is a focus on consistent value and innovative menu offerings that resonate with younger customers. The brand has embraced digital engagement, with a significant rise in loyalty program members and strong growth in app-based sales. Taco Bell's leadership emphasizes staying culturally relevant, adapting quickly to changing tastes and trends. This combination of affordability, innovation, and genuine customer connection has helped Taco Bell maintain momentum in a challenging market. Digital channels and mobile apps have become essential tools for fast food chains in today's competitive landscape. With more customers relying on their smartphones for convenience, brands are leveraging apps to offer exclusive deals, streamline ordering, and build loyalty programs. This shift not only helps companies engage younger consumers, but also allows them to gather valuable data on customer preferences and habits. As seen with Taco Bell's recent growth in digital engagement, investing in these platforms can significantly boost sales and strengthen brand loyalty. Ultimately, embracing technology is now a key strategy for fast food chains aiming to stay relevant and thrive in the evolving market. With all these changes happening in the fast food industry, it's interesting to hear what people think about why some chains are thriving while others are struggling. Maybe it's about the quality of the food, the prices, or even the way these brands connect with customers through digital channels and loyalty programs. Everyone has their own experiences and preferences, so it's always insightful to learn what matters most to you. Whether you're a fan of value menus or you've noticed shifts in service and atmosphere, your perspective adds depth to the conversation. After all, the choices we make as customers play a big role in shaping the future of these restaurants. The fast casual segment is also facing its own set of challenges, as consumer preferences and economic pressures continue to reshape the industry. Chipotle, once a standout performer, has recently experienced a decline in its restaurant numbers and sales growth. This downturn reflects broader trends impacting fast casual chains, including rising costs and shifting customer expectations. As competition intensifies, even established brands like Chipotle are finding it harder to maintain their previous momentum. These developments highlight how no segment of the food industry is immune to the current economic climate. The fast food industry is undergoing rapid transformation as brands respond to shifting consumer preferences and heightened competition. Recent closures and strategic pivots by major chains highlight the challenges of maintaining profitability and relevance in a changing market. Companies are increasingly focusing on value, digital engagement, and menu innovation to attract and retain customers. Those that adapt quickly and listen to consumer feedback are more likely to thrive, while others risk falling behind. Ultimately, the ability to evolve remains essential for success in today's fast-paced food landscape.